Welcome back, everyone. Let's jump right into it, because today we are unpacking a seriously fascinating macroeconomic puzzle, the Federal Reserve's June 2026 decision. It's a moment that left markets a bit whiplashed, and to truly understand it, we need to look past the headlines and dig straight into the data.
So, picture this. You're driving down the highway and suddenly, boom, there's a hazard ahead. Inflation is spiking again. Do you slam on the brakes immediately? Not necessarily, but you absolutely hover your foot over the brake pedal, right? Well, that hovering, that's exactly what the Federal Reserve is doing right now, and it is the central mystery we're going to solve in this explainer.
Okay, let's dive into this. Here's our roadmap for today. 1. The June 2026 decision. 2. Decoding the hawkish hold. 3. Geopolitics versus the economy. 4. Entering the Wuerschel era. And 5. What to watch next.
Section 1. The June 2026 decision, a crossroads for rates.
On June 17th, the Federal Open Market Committee delivered a unanimous 12-0 vote to keep the federal funds target range exactly where it was, sitting at 3.50% to 3.75%. Now, on the surface, a hold was totally expected. But here's the kicker. This was the very first meeting chaired by newly appointed Fed Chair Kevin Warsh, and the way they positioned this hold, that's the real story.
Look at these takeaways. The rate stayed flat, sure, but the committee completely wiped their prior easing bias from the official policy statement. That little hint that rate cuts were coming? Gone. Plus, under Chair Warsh, the statement itself was noticeably shorter and simpler. Just the facts. No sugarcoating, no predictive pattern.
Which brings us to Section 2. Decoding the hawkish hold, the dot plot twist.
First, let's quickly define our terms so we're all on the same page. What exactly is a hawkish hold? Well, it's basically when a central bank pauses rate cuts or holds them entirely steady, but clearly signals that future rate increases are highly likely because of upside inflation risks. They are holding the line right now, but keeping that foot hovering right over the brake pedal.
And you can see this shift plain as day in the Fed's famous dot plot. Back in March, the median expectation was 3.4%, meaning they were projecting rate cuts by the end of the year. But look at June. The median shot up to 3.8%. That is a massive, sudden flip from easing borrowing costs to implying a rate hike before 2026 wraps up.
And the committee? They are split right down the middle on this. Out of 18 officials who submitted forecasts, exactly half, 9 of them, anticipate rates will actually need to rise further in 2026. 8 expect to just hold the line, and literally only one single official projects a cut. Also, fun fact here, setting a brand new precedent, Chair Warsh actually opted out of submitting his own dot projection altogether.
Moving right along to Section 3, Geopolitics versus the economy, the tug-of-war.
The underlying data here is showing some serious tension. Headline inflation hit 4.2% in May, heavily driven by geopolitical instability in the Middle East, pushing gas prices past $4 a gallon. Because of that, the Fed sharply revised its year-end inflation projection up to 3.6%. Now, on the flip side, U.S. GDP growth for 2026 was revised down to 2.2%. So the domestic economy is definitely cooling, but, and this is a big but, unemployment is still holding remarkably steady at 4.3%.
And that steady unemployment rate, that is the linchpin to this whole strategy. The Fed explicitly called out that job gains have kept pace with the workforce, even while inflation remains elevated. Basically, because the labor market is proving so stubbornly resilient, the Fed has the breathing room it needs. They don't have to panic cut rates to save jobs. They can afford to keep rates higher for longer to fight off that energy-driven inflation without immediately triggering a recession.
All right, Section 4. Entering the Warsh era, a new chapter for the Fed. We are already seeing how Chair Kevin Warsh is bringing a totally different philosophy to the central bank. The previous era relied heavily on forward guidance, basically spoon-feeding the markets exactly what to expect months in advance. Warsh is completely abandoning that. He's opting for data-dependent facts. Instead of lengthy, predictive statements, we're getting shorter, simpler releases that give the Fed maximum flexibility to react.
To pull this off, he's basically taking the central bank back to first principles. He launched 5 new task forces to completely overhaul how they operate. They are revamping their communications, the management of the balance sheet, data gathering methods, their core inflation frameworks, and, super interesting and timely, studying the economic impact of artificial intelligence. It's a real top-to-bottom reset. And Wall Street is actively digesting this shift.
As you can see with the Treasury yield curve, the bond market is aggressively repricing for this higher-for-longer outlook. Investors are finally waking up to the fact that with sticky inflation, geopolitical wildcards, and a Fed chair who refuses to play the forward guidance game, the era of cheap, perfectly predictable money is over for now.
Finally, Section 5. What to watch next? The road ahead.
Here is your timeline to keep handy. The absolute next critical milestone is the FOMC decision on Wednesday, July 29th. Then we hit September, which is huge because we get another closely watched dot plot update, followed by the fall meeting in October and wrapping up the year with the December meeting. Every single one of these dates is going to be incredibly high stakes as the new data rolls in.
Which leaves us with one final pretty provocative question to ponder before that July meeting. Will the provisional U.S.-Iran peace deal actually cool off energy prices in time? Markets aren't even debating when the Fed will cut anymore. The real debate is whether fading geopolitical shocks might just save the Fed from having to hike rates again. We'll be tracking those July inflation prints closely, and I highly encourage you to do the same. Thanks for joining me for this explainer, and I'll catch you next time.